Good morning. This is the New York City Fire Pension Fund investment meeting. We are at One Battery Plaza in the ninth floor conference room. This is a hybrid meeting with some attendees participating via Zoom. Today is January 14th, 2025. It is 9:50 in the morning. We will begin with a roll call. Mr. McInnes.
Thank you, Commissioner. Representing Mayor Eric Adams.
Kevin Liu for Mayor Adams.
Good morning, Kevin. Representing Comptroller Brad Lander.
John Dorsett, designee for Comptroller Brad Lander, present.
Hello, John. Representing Commissioner Preston Niblock of the Department of Finance.
Nadia Fazulina for Commissioner Niblock.
Good morning, Nadia. Representing the UFA, Mr. Andrew Ansbro.
Chris Viola with Andy's proxy.
Hello, Chris. Mr. Robert Eustace.
Chris Viola with Robert Eustace proxy.
Good. And of course, Mr. Christopher Viola.
I'm actually here.
Good morning to the three of you. Mr. Dennis Tavetta.
Here.
And Mr. John Young.
Here.
For the UFOA, Mr. Joseph Camastro.
Here.
Mr. Liam Guilfoyle.
Here.
And Mr. Sean Michael.
Here.
Hello, Sean. And representing Fire Commissioner Robert Tucker.
Lizette Christoph here.
Good morning, Commissioner. And just for the record, although we introduced them last month, my new Deputy Director, Christopher Jensen, is in attendance. We have
That was a welcoming sound. Okay, so we will begin with the public agenda. I'm going to turn it over to the Comptroller's office.
Thank you. And good morning. I just want to say Happy New Year to everyone. I know that it's past the Larry David point where you're allowed to say Happy New Year, but since this is our first meeting of the year, I think it's still appropriate to say Happy New Year. I think all of us are looking forward to an exciting year, and we are optimistic that the stock market will cooperate with us and hopefully help us into more prosperous, turn this into a prosperous year. So with that, I'm going to turn it over to Steve Meyer to give us a market update, and then we will proceed to the executive agenda to discuss specific investment matters. So Steve, you can use that mic, or if you want this one, really.
Morning, trustees. Actually, I think we're optimistic, but we're cautiously optimistic. I want to be clear on that. I'm going to give you just a quick 3-minute update on what's going on in the economy, what the market's doing, and how your portfolio is performing. On the first slide, if you could advance one, please. I don't know if there's a lot on that slide. You can see on the upper left-hand side, GDP growth is actually still quite strong in the U.S. It's down a little bit from where it was in the prior quarter at 3%. It's at 2.8% right now. But still, if you look at trend growth in the United States, closer to 2.2%, quite solid. And another one of the leading economies in the world is at 4.6%, down a little bit as well from the prior quarter, but below expectations around 5%. So underperformance there. And the rest of the world continues to languish. You see the UK coming in, which is about what's forecast for the next 3 United Kingdom, Japan, technically. The global economy is not doing that great. The U.S. performer, and expectations are for hopefully that to continue on as we change administrations and a new president takes the helm next week. Inflation. Green numbers on the right-hand side of that chart on the bottom are not necessarily positive, although they do indicate inflation pretty much the board. As measured by CPI, inflation in the U.S. is 2.8%, up from 2.6%. And again, across the world, it's moved up a little bit. It's been stickier. Implications for that are probably higher official rates for a period of time. On the upper right-hand side, look at employment. We've got a 4.1% unemployment rate through December of 2024. It's actually down a little bit from 4.2%. We had non-farm payrolls last Friday, and if you didn't catch it, there was a consensus estimate for about 165,000 jobs created for the economy. It actually came up with employment to be quite strong. And on the bottom right-hand side, it's and it's actually straight to the US dollar. So the dollar is strong for a number of reasons. We have higher interest rates, both official and longer term than many of the competing currencies out there in countries. We have actually a higher growth rate and higher levels of trade, asset price appreciation, which is potentially a safe haven given geopolitical risks associated again with some of the developments in Ukraine and the Middle East and in Africa as well. On the next slide, a quick look at rates. You can see official rates on the upper left-hand side, and I apologize. We probably need to think about these slides a little bit. They're excellent, but they're hard to read, certainly at a distance. But I'll just get through it real quick. You can see on the upper left-hand side, official interest rates in the United States have come down 100 basis points over the last few months since September. They've actually come down about 50 basis points in the UK, down 100 basis points or 1% in Europe. The outlier is Japan, moving from a negative 10 basis point official rate to now a 25 basis points. So still very, very low interest rates in Japan, but again, a little bit of an outlier that they're moving higher. On the right of that, you can see where credit spreads are. And you can see on the top of that where it says current spreads are about 80 basis points or 0.8 of 1%. That's a fancy way of saying if I buy a corporate bond relative to a treasury with the same maturity, same duration, I pick up 80 basis points in additional yield. And in the high yield space for non-investment grade corporate bonds below a BBB minus rated, the pickup there on average is 280 basis points, again, which helps power the return and reduce the duration of your high yield holdings, which I'll talk about in a moment. The last point in this slide is the big green bar. You can see we've gotten more of a normally shaped yield curve. This actually looks back to November 6th of 2024. It's still inverted on the very short end as short rates continue to move lower and are expected to continue to move a little bit lower with additional Fed rate cuts. But more importantly, if you look at, say, 2s to 10s to 30s, you're actually receiving a premium to invest further out the curve, certainly to a more normal environment. On the next slide, a quick look at market returns. On the left-hand side, you can see year-to-date returns for the full year 2024. Obviously, the takeaways here, I'd focus on, say, the S&P 500 that came in almost 22% higher. If you include dividends, that's a 25% return. We've actually had 2 back-to-back years with close to 25% returns in the S&P 500. While we like to be optimistic, we're cautiously optimistic, and we don't think that will repeat in 2025 necessarily. And just a reminder, across the 5 different general consultants for the 5 different and unique New York City pension plans, the consensus estimate for public market equity returns over the next 10 years on average is 6 points. So again, 22% plus dividends at 25%, that's an outlier. On the right-hand side, this is really a look year to date 2025. And it looks at 10-year sovereign yields across the board. United States, we've seen a backup in yields. Current yield this morning in the U.S. 10-year treasuries at a 477. If you remember back at their recent low level in September of 2024, they were at 363. So over 100 basis point move to the upside, which is doing some of the heavy lifting for the Fed in terms of starting to slow the economy. But again, if you look all the way down across the regions, 10-year sovereign yields are higher, with the exception of, say, China at the bottom. And on the next slide, last but not least, for this section, just a quick look at your performance relative to the underlying asset classes for different periods. So for the month ending November, and U.S. equities, for example, was up 6.8%. Equities had a significant rally, and so did other risk assets like Bitcoin and the like, associated with the election of Trump. And potentially the reason for that is the expectations of a pro-growth, pro-business agenda that will make it easier for businesses to get things done. And you can see across the board, I'd say the most important thing I look at is 10-year returns on the far side. So US equities on average over the last 10 years, again, November through November of 2024, produced returns of 12% and on down. I'd say the other thing that really kind of jumps out at me on this slide is the second to last asset class, infrastructure. On annual basis, on 1 and 3 steady Eddie, it's 11% returns, 11% returns, 11% returns, and on average over the last 10 years, 2 years. 2%. So the last thing I would take away from this slide is looking in the 1 year, the middle of the page. U.S. equities have a 32.5% return, which is again not necessarily.
So,
Please don't.
I don't know, do you have a question? Can I go first? Please. Okay. So my question is, if we look at the 10-year returns and we were to look back at the asset allocation that we passed, where we had some projections from all the consultants collectively, but in this case from NEPC, if we look back to what we passed in the asset allocation based on the assumptions and look at those 10-year returns, how much have we deviated from that? And so what I'm trying to get to is we adopt an asset allocation. It's a long-term plan. It takes us some time to get to that plan. It's based on assumptions, but we can see the 10-year return. Does it look like it's playing out? Does it look like it's in line, or are the assumptions just not relevant? Maybe it's hard to just answer on the fly, but I'm just kind of curious. We've asked people to run scenarios. We've done different things, and I'm just kind of curious how it plays out.
That's actually a really great question, John. I'd say the thing that surprises me about the returns we've seen over the last decade are the preeminence in the outperformance of U.S. equities and the underperformance of other economies. Again, that's been the case for the last 15, 16 years coming out of the global financial crisis, 2008, 9, and spilling into 2010. So that's an outlier and a surprise to me. I think in terms of the current strategic asset allocation, John, you've actually reduced your exposure to equities generally. You've increased your exposure to private equity, for example, which I think is going to be a strong performer, notwithstanding the fact that it's had a couple of challenging years. And as I said, I have complete confidence in Nash and his team's ability to navigate those rough waters. I do think that a lot of the deals that the trustees have looked at, analyzed, and passed in the last couple of years will have outsized performance in your portfolio in 3, 5, 7 years. It's because of the co-investment and just the access and the better economic terms that we're able to negotiate. The other areas where you've increased exposure are infrastructure, again, which is steady Eddie and a really strong performer. And I think we benefit in particular in that space by having a really good team. I think Petra Nikolova, the DCIO, is probably the very best in that asset class in the industry. And the last point I'd make is alternative credit. I do think that you're looking at returns out 10 years at 7.2%. You have to remember, most of that time we had near zero interest rates. Again, coming out of the global financial crisis through the 2010s, and then certainly during the pandemic. So with higher base rates, higher official rates, and more opportunity in that sector, I think that'll be a really good performer as well.
And I guess my last question with regards to this slide, as we continue to become a mature plan, we already are a mature plan,
Sure.
because we continue down that road and our assets become more sophisticated, our investments. Does the idea of separating out developing and emerging still make sense? Or should we start thinking about it a little bit more non-US catch-all? And that's more, I'm just trying to tease out whether or not, and I think John's here, so I know we're going to hear from the team later on this morning, but it's just something I'm just looking at this, noticing that like in the past, we would have broken out municipal bonds from corporate bonds, and now we just use core fixed income. So it's really not whether or not we eliminate a program. That's not my point. My point is from a labeling and a presentation standpoint, does it make sense still to keep this like emerging markets separate from developing? Or should we think about them all together?
On a global
as-
basis.
In a more global basis? That's just like food for thought. you know?
That's a great observation. It's something that I think we really need to be thinking about. How do we bucket things? So yeah, you're right, John. We could think about it on a global basis, which I think we need to do more analysis. I'd say the last point, John, not to speak away from your topic, fixed income. You can look at 3-year returns at negative 1.9% in core fixed income, and fixed income struggled. But remember, during the pandemic, you had interest rate, US 10-year treasuries yielding just 67 basis points. You're 410 basis points above that. So now fixed income, and those base rates will help high yield, certainly help alternative, help core, help investment grade fixed income. So more income. I know, Liam, you were kind enough to send me a note over the weekend, raising some of those similar types of questions. Fixed income is starting to generate some of that income that will help power and support the yield portfolio. So
I'm gonna wait on my question until we get to the slide.
no, I'm all set. Yeah, I'd say the only other takeaway is your total plan returns are at the bottom. And you can see how 10 years, 7.5%. For the 1 month is 2.4% for the month of November, again, with that rally, that post-Trump election rally. And in 1 year, that 14.6% return, again, given the private asset lagged and with the market markets, still an outsized performance that I don't expect it necessarily to continue. But I am cautiously optimistic about our ability to continue to hit something 10% return objective and maybe a little bit more.
What gives you the most pause in the market right now? What keeps you up at night?
I mean, you have to acknowledge that we have highly concentrated the U.S. Stock across the Mag 7, the Magnificent Seven companies. That has a disproportionate impact on the S&P 500 returns and U.S. equities generally. I'd say the other side of that is those companies are all actually incredibly well, great free cash flow. They're profitable companies. We're in an artificial investment super cycle. How much of that is priced in, and how much of that will actually? I actually believe artificial intelligence is for me. It's a question of timing. How long does it take to implement and actually leverage that technology in an effective way that improves productivity and improves performance of companies?
Howard Marks actually wrote, I don't know if you saw one of his last newsletters on whether or not there's a bubble.
Yeah, I have it printed. Liam, we actually have Howard Marks 2 weeks from Friday. 1 week from this Friday, we have a technical strategist, Thomas Mucha from Wellington. It's followed by Sharmeen Mossavar-Rahmani. These are three of my very favorite, and Sharmeen is shelf. So there'll be a lot of good questions. But I was very thoughtful around risk, and I think that's going to be the focus of the conversation.
And I'll be the fourth week. So it's gonna be great.
With John.
It's gonna be great.
No, but you read a lot of articles where there is concern about the private equity world. There's obviously not the same disclosure as there is in public equities. And so for the non-savvy investor, the ones who really don't know as much about those things, start reading those articles, it brings up a lot of questions. And I know the returns obviously are what they are, but just curious if there are any concerns on your side of the table going into the future about the private side of the world.
So leverage. Paul, she just walked in, spent a lot of time on focusing on those managers that can deliver value, multiple attention, and not simply leverage. I think we're in pretty good shape. Nash, why don't you comment?
The only thing I'd add is that it's true when you read the press about what's happening in the private equity industry, there isn't a lot of transparency because it's a private market, right? So the general public and journalists and outsiders don't know what's happening inside of these partnerships. But as an investor in these partnerships, we do have transparency into how these companies are valued, whether the valuations are reasonable, what the managers' strategies are with improving the value of these companies. So In many ways, we actually have more transparency on these portfolios than what you get in the public markets. So that is a meaningful distinction that I think is sometimes lost, in the press. People are looking at this from the outside and they don't get as much information. But as insiders, we have a lot of information about these portfolios and, again, what the plans are for increasing the value of these companies.
Also, Nash and Petra sit on a lot of LPAC, teammates sit on a lot of LPACs, which is a limited partner advisory committee for the general partners that you invest in. So even more insight than, say, your average limited partner investor. So, yeah.
Can I just make one other point, just a general observation? Many of the articles that I see are about private equity in general. And I think you need to realize that as a sophisticated plan, the people you're investing with are the top of the heap as far as performance, regulations that they follow, things that they file for investors. They're not fly-by-night investment companies. So this is the top tier of the investment world. They don't raise a second, third, fourth, or 10th fund without being very good at what they do and having been vetted by many people, including the Bureau of Asset Management, as well as the consultants. So when I see a lot of these articles, they're grouping private equity in as one big, entity, when we're really looking towards the cream of the crop, right? So I just think that that's an important delineation for people that are just zooming in to watch this, that all of the things that we see before us here and any of the retirement systems of the city see are always top-notch opportunities. Now, whether or not they pan out is going to be determined on a lot of different factors, but the starting point for all of the investments is finding the best of the best and working from there. It's not trying to find some obscure manager that, we were trying to roll the dice on. We're not here to gamble with members' benefits. We're here to find the best opportunities, or at least the Bureau of Asset Management. I mean, to be clear, I'm not in for that purpose, not doing investments here. That's what they're trying to do, and that's what they're bringing us as a board. So I just want to make that point, because you do make a point. People do zoom in to meetings, trying to get an understanding or answers about things that we do. It's not as non-transparent as people think it is. So I think that that's an important point.
And just try to put this as best I can. Even though I know that that's what's going on, Peter Lynch had a pretty interesting take on how the individual investor could do better than the professional investor, because they're not beholden to the world of newspapers. So I can be in a stock or not in a stock, or other people like, how are you not in that stock, especially as a professional? So there still are the Enrons of the world. People got duped. There are the Madoffs of the world. That's really smart people got duped. So when you read those articles, it does bring questions to light. Just more curiosity than anything else.
Okay, so I know enough to quit when I'm ahead because I had two good questions. So, all right, that concludes the public agenda. So I'm going to make a motion to exit public and enter into executive session.
Second.
Okay, all those in favor?
Aye.
Okay, so we are now entering into executive session. Please stop the recording. During the executive session, the board discussed various investment matters. I don't believe that there is anything else on the public agenda, so I would welcome a motion to adjourn.
So moved.
Second.
Any opposed? Hearing none, the motion carries. We are adjourned. Thank you all.
Thank you.
Thank you.